morning, everyone. Welcome you to join us today's virtual meeting. We're so happy to see you today. I am Pauline Lam, your education chair this year. Today, we have a great honor to welcome Mr. Tony Watson from Robert Hall Associates. He is very popular and famous, and he's a great speaker, one of the greatest speaker I know. And I meet you, Tony. Today is the third time. The first two times is live, in the live activities. Today is virtual. You look so handsome, still so sunny. We welcome you to give us a presentation how our realtor should do anything preparation for tax relief to get through the pandemic situation. And thank you so much, Tony. It's your time.
Absolutely. Thank you so much. It says that my ability to share the screen is disabled. Is there any way that I could share my screen so I could show the presentation?
Yes, one moment. Let me see. Go ahead. You should be able to share it.
Okay. It still says host disabled attendee screen sharing.
Okay, one moment.
Sure. There we go. All right.
Okay. Sorry about that. Okay.
Not a problem. And can everyone see the PowerPoint screen?
Yes.
Excellent. Well, thank you everybody for joining today. My name's Tony Watson. We've got a lot of information to go over in a brief 45-minute time period. Today we're going to focus mainly on what's been going on over the past 3-4 months, right? The CARES Act, what was implemented over the last 3.5 months, what to look out for when applying for the PPP loans, the EIDL loan, and where we're at with that. Don't have too much information on the HEROES Act yet because it hasn't fully passed. But we will obviously come back later on in the year with an update when that fully passes and we have the dust settles essentially around that third round of financing support. We've had quite an interesting past 3 months. We've had quite an interesting 2020, to be honest with you. Tax season started off as normal for us as tax preparers, and then all of a sudden in February, when the pandemic really hit hard and the economy started to shut down, we moved completely digital. So this is a little bit not new for us to do things, the seminars and the webinars digitally, but I think that it has created a new avenue for us to educate individuals across the globe, when it comes to tax planning and tax information and things that are implemented by the federal government each year. So thank you so much for spending time today to be with us. Tax implications of the CARES Act, what real estate and small business professionals should know, obviously moving throughout 2020, what to look out for, some of the pitfalls of the CARES Act, some things that are truly beneficial that are built into the CARES Act. So we're going to cover a little bit of everything today. Just a brief background of who we are and what we do. My name is Tony Watson. Once again, I work for Robert Hall & Associates. We've been around since 1971. We do taxes in all 50 states. There isn't a state that we haven't filed a tax return in. We help small business owners incorporate. We run payroll. We do year-end planning. We do a little bit of everything. We have legal representatives in the building, tax attorneys, real estate investment vehicles, DSTs, and wealth managers. So we're pretty much an a la carte one-stop shop. So if there's anything that you ever need a referral for in the financial industry, go ahead and reach out to us, and I'm sure that we've got somebody in our Rolodex. Let's start off by just touching on a couple things. Over the past 3.5 months, our phones have been ringing off the hook with questions about the CARES Act. What does it mean for them? What does it mean as a whole for the economy? What are the tax implications? What are the tax benefits that I can take advantage of? And so I've narrowed down a lot of the phone calls into 5 subcategories that I'm going to touch on today. First and foremost, the PPP and the EIDL loans. The question of mortgage forbearance, whether it's a benefit or whether it's just kind of delaying the inevitable, accelerated depreciation for rental property investors and other real estate professionals alike, and stimulus checks, where are we at with those? And then obviously the #1 crime in America and also the #1 crime globally, identity theft, and what to look out for there when applying for loans, when filing a tax return, so on and so forth. So we're going to touch on a little bit of all of that. We're going to spend most of the time, though, on a couple of the major changes in 2018's tax reform bill. We're going to talk about that later on in the PowerPoint. But first and foremost, we're going to talk about the 2 kind of poster children of the CARES Act. the PPP loans, and the EIDL loans. Now, I'm sure that you all have heard about this. You've educated yourself. You've listened to other webinars. You've heard other professionals speak about it. And things continue to change as the days go by. Some things with the PPP program and the EIDL have changed literally over the past week to 2 weeks. So just understand that, and I do include in every PowerPoint slide in today's webinar, that at the very bottom it says this information is subject to change without notice. When something is changed, we hear about it in our accounting forums, and we learn about it, and then we bring it to you via webinar or educational seminar in some way or other. But the Payroll Protection Program has been a huge benefit for business owners across the U.S. The main benefit of the PPP program, though, the Payroll Protection Program, was meant to keep people on payroll, meaning that if I owned a restaurant and I had 15 employees, waiters, waitresses, bartenders, managers, the Payroll Protection Program was meant for me for a support program for me to keep all of those individuals on my payroll. That was the first reason for the Payroll Protection Program. However, you don't need to have employees to benefit from the PPP program. That's as the weeks went by when they first rolled out the CARES Act, we realized that there were two forms to the PPP program, right? The one avenue would be to apply for the PPP and keep all of your employees on payroll while your restaurant was shut down or while your business was shut down, right? If people aren't coming in and you're not doing business, how are you going to afford to pay all of your employees, right? So the Payroll Protection Program was meant to supplement that loss of revenue and keep everybody from going into unemployment. For the single business owners, however, which are a majority of my real estate professional clients, they don't have employees. They might pay contractors here and there, but no formal employee agreements. They are technically the only employee of their business, whether they're a sole proprietor or an incorporated entity actually issuing themselves full-blown payroll. Well, when you read Payroll Protection Program, you have to ignore the word payroll for a second, because a lot of individuals, when they thought of the Payroll Protection Program, it was only for businesses that had payroll, when in fact, for the sole proprietor, it actually was meant to also supplement loss of revenue for that individual as well. So when you were applying for the loans, it was confusing as to what numbers you were supposed to report if you didn't have payrolled employees. It was pretty straightforward if you had payrolled employees. You just submit all of your payroll up until the time the pandemic hit. And when you submit that to the bank, and then they calculate whatever your PPP program is for the employees of your business. But then don't forget about yourself. You are also employed by your business. Once again, whether you're a sole proprietor or an actual W-2 employee. So when you were applying for the loan, the bank or whoever was helping you fill out this application, they were looking at a 12-month revenue period. So 12 months either of 2019 or 12 months up to the time that you were impacted by the pandemic. And they were looking at your monthly cash flow, your monthly profit, not what you were bringing in total, but what you were bringing in minus all of your deductions gave you your net profit. And so dividing that over 12 months gave you your monthly net profit. That number is the number that the banks were supposed to use when calculating your PPP loan amount. So let me give you an example. Let's say that in 2019, after all of my business expenses were deducted, let's say that my profit was $120,000, so $120,000. 120 divided by 12 months gave me a profit per month of $10,000. So the bank, when they were filling out the application, they would take $10,000, which was my monthly profit, and they would multiply it by 2.5 months or 2.5. They essentially used that 2.5 marker because they thought that the pandemic, the economic shutdown, and the time period that business owners would be impacted would only be 2.5 months. So they took $10,000 in this situation, they multiplied it by 2.5 months, and that gave this individual in this example, this is not a generic number, this is just an example, that gave them a $25,000 PPP loan, so 10,000 times 2.5. And that $25,000 was funded basically within 3 to 5 days after an accepted application. Once that money came into your business account, whether you had employees or whether it was just you running your business, you had a certain time frame to spend that money on what are called or what are defined as forgivable and allowable business expenses. So the $25,000 comes in, and about 2-3 weeks ago, everybody understood that it was an 8-week time frame that you had to spend this money. Literally, at the day that it funded, over the next 8 weeks, you had to spend this money. Well, just a week and a half or 2 weeks ago, the federal government or SBA came out and said, well, we actually want to change that rule. We don't want to say that you have to spend it immediately. We are going to alter it to, it can be any 8-week period throughout the year, but it has to start at the time that you initiated ordinary payroll for yourself or for your employees. For instance, if you only pay yourself once a quarter, why would you get the PPP loan and then pay yourself right away? You should wait until you normally pay yourself, because it has to be consistent with how you've been operating your business over the past 12 to 15 months, essentially, basically in 2019 up until the pandemic occurred. So there are some slight changes to that rule. I know a lot of clients who got the PPP loan in February and March, they've already spent the money on the allowable expenses when they probably could have waited a little bit and then been subject to the new change to the PPP rules. But anyway, water under the bridge. It's an 8-week period that you have to spend this money. Now, you have to take this, let's use the $25,000 example again. Once you get the $25,000, you have to utilize, in order for the full loan amount to be forgivable, meaning that you don't have to pay it back to the lender, you have to utilize 75% of the $25,000 for payroll expenses. Now, you can't bonus yourself out. You can't pay yourself an unordinary amount as payroll, meaning that it has to be consistent with what you paid yourself over the past 12 months. You cannot use it to go out and buy a new car. You cannot use it to buy new computer equipment. You have to use this money for very specific things. 75% has to be used for payroll, meaning that if you have payrolled employees, that 75% has to go to them and to you. So you have to calculate how much you spread across the employees, including yourself. You can also use the additional 25%. So 75% goes for payroll. The 25% above and beyond needs to be used for other ordinary business expenses that basically you can't afford to pay, or even if you can afford to pay, that are ordinary and necessary business expenditures, meaning rent, utilities for your business office expenses, your mortgage interest if you have a mortgage on your business property. You can use it to pay for medical expenses. If you cover health insurance for yourself, you can use part of the PPP program to pay for health expenses. So just understand that 75% minimum has to go to payroll. If you use 100% of it as payroll, that's fine as well. You don't have to split it 75-25. But what we've heard from some of our clients who have received the PPP loan is that it was difficult to spend the full 75% on their payroll because it wasn't consistent with what they were earning over the past 12 months. So they were only able to hit that 75% number, and the 25% was left over to pay for these other ordinary and necessary business expenses. Now, let's say that you get this PPP loan and you can't spend it all. For some reason, you're just running into issues. It's not consistent with your payroll, or you've already paid yourself and you just can't spend that 25% because it's too much on other expenses. Do not worry, because if you can't spend it all on the forgivable expenses, it converts to a loan at the end of this 8-week period into a 1% interest rate loan. Basically, whatever is left over, you pay 1% interest on over the next 24 months. Now, the first payment that you have to make doesn't occur until 6 months after the loan funds, or after the 8-week period. So you have half a year to make your first payment on this loan. And even then, the interest rate is only 1%. So it's not like it's the end of the world if you can't spend it all. But a majority of clients, from what we're hearing in our industry, is that a majority of people want to spend it on everything that will be forgivable. Now, let's dive a little bit further into what technically is the definition of forgivable, because here's where a lot of misinformation is out there right now. I get the $25,000, okay? In order for me not to have to pay the money back, I have to utilize it for the 75% payroll and 25% other allowable expenses. If I spend all of that, if I spend 100% of the loan on the forgivable expenses, I do not have to pay the money back to SBA. Great. It's not income to my business. It's not a payback loan, except here are two kickers with this. If I get the $25,000 and I use it to pay for all of these expenses, next year when I file my 2020 tax return, I cannot deduct the expenses that I paid for with money that wasn't mine. So the way that the old and the new Internal Revenue Code is written is that when you have a loan that is a forgivable loan, it is not income to you, which is fine, and that's what we don't want. We don't want it to be income. But if you utilize that forgivable money, that loan that you don't have to pay back, to pay for all of these expenses, the government says, well, you cannot deduct those expenses then because you didn't pay for it. SBA technically did. So just be aware that next year you need to do some planning this year to figure out, oh, well, if I paid $50,000, $60,000 in payroll with my PPP and I'm not going to be allowed that expense, well, I need to make sure that I'm not going to be hit with a big tax liability next year once the economy does open back up and I get back to work and I'm starting to make money again. I needed those expenses. So there might be a slight adjustment on the back end. Furthermore, if you are a sole proprietor, meaning that you don't have employees, and you got this PPP loan and you paid yourself, remember that the PPP loan, because you used it for payroll, you don't have to pay it back to SBA. But what did you just do? You took the PPP loan and you compensated yourself for services that you provided for your business. So guess who does pay income tax on that next year when you file for 2020? You do, because you paid yourself a payroll. Just like if you have employees, if you use that PPP money to pay your employees, they will pay income tax on that money next year when they file for 2020. So just be aware that it's not that the PPP loan isn't taxable. It just means that you don't have to pay it back to SBA. When the full cycle goes through and you actually use that to compensate yourself, individually speaking, you have to pay income tax on that, okay? So just be aware that you need to plan for a lot of these tax implications of the payroll protection program, and just make sure that you're ready for any of these particular situations, or ready for this particular scenario, okay? That's the impact of the loan on taxes for future lending. Well, for future lending purposes, it actually should be great because for one of two reasons. One, you're actually keeping up compensation on your 2020 tax return, 2020 individual tax return. The actual loan itself could impact your ability to qualify for lending in the future, but it really all depends on your specific situation. I can't really speak generally about who it may impact, but the PPP loan is a loan to you as a business owner. But remember that if you're taking it to your business, it probably isn't being reported to you personally, and unless you're a sole proprietor. So once again, every situation is unique and different. You want to have a conversation with not only your lender about this, but also your tax advisor to figure out if you individually were leveraged personally, and that if that may impact your ability to acquire financing or buy homes down the line by yourself individually. Not under a business, but under your personal social. Employee retention, the main point of the payroll protection program was to retain employment. It was not meant for you to go out and pay off a car or pay off credit card debt. That's not what the payroll protection program was for. It was meant to retain employment or to supplement loss of revenue for a sole proprietor. But it does not mean that it's not taxable to you personally, because remember, it comes in and you paid yourself. Also, what I'm running into right now with questions is, hey, I have the PPP loan and I'm spending it on compensating myself and my employees, but I also want to take advantage of PUA, which is California's contract unemployment benefit right now, which is like $600 a week. It's a great benefit for a lot of people, but if you applied for the PPP, that means that you have money to keep yourself employed. So you cannot apply for PPP and PUA at the same time. It contradicts itself. So if you haven't applied for PPP, PUA is a great benefit. If you haven't applied for PUA and you've applied for PPP, do not apply for both. Because at the end of the day, the payroll protection program was meant to keep you employed, not unemployed. So just be aware that there may be some tax implications on the back end because of this. You may have to end up paying back a good portion of the unemployment or the payroll protection program money, or it converts to a loan. So we don't have any final legislation on this. We don't have any case study on this. This is all very new. It's all within the last 3 months. I mean, and it changes every week. So just be aware that as the dust settles further on towards the end of the year, we'll have more legislation on this. We'll have more defined codes from the IRS. And also after this November election, we'll probably have some other changes to the tax code as well, maybe even some more relief programs. So just be aware that things are changing, but as it stands now, the payroll protection program was meant to keep you employed, not for you to get this benefit as well as unemployment benefits. So just keep that in mind. That's the PPP plan. The EIDL loans are much different than the PPP. The economic injury disaster loans, actually at the moment, SBA has stopped accepting current applications. They are only processing applications that had already been filed as of about, I think, 3 weeks ago. So it doesn't mean that they're not going to open up again for new applications, but it does mean that at the moment, if you go and file an application, it's not going to be accepted because they've put a halt for the foreseeable future on applications for the EIDL loan. The HEROES Act is going to refund some of these programs. So just understand that it doesn't mean that you're kind of out of, out of luck. I think that in the next couple months, we're going to see another relief plan coming out that will refund EIDL. There's still PPP loan money out there. So if you haven't applied for the PPP and unless you've already applied for unemployment, don't apply for PPP. But if you haven't applied for unemployment and you think that you may take advantage of PPP, go ahead and do that because there's still money there. EIDL, there's no more money at the moment for new applications. So they're still currently working on already filed applications. The EIDL loan is different than the PPP. It is not a forgivable loan, meaning that you can use the EIDL loan to pay for whatever the expenses are. You can use it to pay for payroll, for rent, for utilities, whatever. But at the end of the day, this is a full-blown loan. At the moment, the loan max amount is $150,000. It started off at $2 million, meaning that if you had gotten in the first round of funding and part of the second round of funding earlier in the pandemic, the economic shutdown, you could have applied for a loan of up to $2 million, depending on your credit score and the amount of employees that you have, the amount of money that you need. But they run your credit. They actually make sure that you have assets to leverage against this debt so that you can actually pay it back. And there's a 3.75% interest rate on a 30-year term for these loans. Now, $2 million at 3.75%, sign me up any day. But because that money went so quickly, SBA actually dropped the loan amount from $2 million down to $150,000, so it lasted longer. And once again, they're still processing currently filed applications, so some clients haven't even gotten their loan yet. Here's the confusing thing about the EIDL, though. When you went to apply for the EIDL, there was one application, and on that application, it was either for the regular EIDL loan or the grant loan, meaning that once you check that box for the grant, you were actually applying for something called the 10K grant, which gave you $1,000 per employee that you had, meaning that if you're a sole proprietor, if you're just a single business owner, just no employees, when you applied for the EIDL, if you checked the grant box, you probably only received $1,000 of the EIDL grant. Now, this $1,000 at the moment is not taxable. It's not income to you. You don't have to pay it back. It basically is a freebie $1,000 amount that you applied for. Okay. And that $1,000 was for every employee that you had. So I could have up to 10 employees and get $10,000. That's how it worked. If I'm just a single member business owner, I only got $1,000 that deposited. And you probably thought, well, that's strange. I'm surprised I only qualified for $1,000, when in fact you probably only applied for the grant. You would have had to apply, and some lenders actually did this for their clients. So if you went to your bank like Wells Fargo or B of A, they might have filed both applications for you, one for the grant, one for the actual EIDL loan. But if you didn't file for the EIDL loan, then you only got the $1,000 per employee. If you didn't file for the grant, you probably qualified for a lot more of the EIDL, and that was an actual loan, or that is an actual loan at 3.75% over a 30-year fixed term. They do run your credit, so this is something that definitely would impact your ability to qualify for financing in the future because it shows up as an actual loan under your Social Security number. So just understand that the PPP and the EIDL, two completely different loans. Two completely different structures. One is not a forgivable loan. The other is. The $1,000 grant is not even a loan. It's just $1,000 per employee that the CARES Act was issuing out to general business owners. So understand that there are major differences between the two. Could you apply for the PPP and the EIDL? Absolutely. Can you apply for EIDL and unemployment? Sure. Can you apply for PPP and unemployment? No, because PPP was meant to keep you on payroll, not be unemployed. So hopefully that makes sense. I did want to just go over a couple other things aside from the PPP or the EIDL. One thing that we were getting a lot of questions on is mortgage forbearance. Should I stop making my mortgage payments? Should I call my lender and request a refinance? Should I modify my loan? Understand one thing right out the gate. If you can afford to pay your mortgage, if you can afford to pay your mortgage, pay it. Okay. Don't stop making mortgage payments on your home because they will absolutely foreclose on your home as soon as the state of California releases the ordinance where it says that they can't foreclose on your home right now. So just be aware that if you can afford to pay your mortgage, pay it. For the individuals who have rental properties where their renters have stopped paying, or if you've lost your job and you can't afford your mortgage payment, there is this 180-day period that you can request with your lender, not calling me and asking me if you should not pay your mortgage. I'm not a lender. I'm not going to tell you to make your mortgage payment or not make your mortgage payment. I'm going to tell you to call your lender because the lender is the person you need to deal with this request. So the first extension is 180 days. And this is not relieving you of paying your mortgage. It's not like winning the lottery and avoiding $5,000 a month in mortgage payments. This is just kicking the can down the road. Okay, so 180 days later, yes, the bank is going to request for you to start paying your mortgage again, whether it's a lump sum at that time, whether it's spread out over a 3 to 5, 6 month period, whether you can actually at the end of this 180 days refinance your loan and wrap that into the backside of the loan. Every lender is different. Every lender is treating this differently. So you want to talk to your specific lender, the person who holds the debt on your property, and ask them what kind of relief programs they have for you. This is not something where you, once again, are not paying interest on your loan. There's no additional interest or penalties on this amount. But if you go the full 180 days without making a mortgage payment, you need to make sure that the lender knows about it, number one. Number two, allows you or is more flexible with payment terms rather than requesting a lump sum payment at the end of the 180 days. Let's say that at the end of the 180 days, you still can't afford to make your mortgage payment. There is another extension of 180 days. So 360 days you can go without making a mortgage payment, without making an interest payment, living in this home. But make no mistake, this money is still accruing for you plus interest. This is how the banks make money. So just be aware that this is not really a benefit in my mind. This is more of a relief plan. It's just delaying the inevitable, essentially. So you need to talk with your lender. We've seen a lot of people go through refis, dropping their interest rate, extending their term, skipping a month of mortgage payment. So just understand that that's more of the formal process for the property owners. You don't really want to opt for this first. You want to see what other options your lender has in place for you and take whatever options they have before the mortgage forbearance option. But once again, talk to your lender directly. Do not call your financial advisor. Don't call your tax preparer. We can't do anything with your mortgage. You've got to talk with your lender about that. Okay. Accelerated depreciation for rental property owners. This is a huge benefit for people who own property. This is the ability to go back to 2019 and 2018, or if you want to wait till next year to file for 2020, you can take QIP, Qualified Improvement Property, QIP, and you can, in some cases, take some of that 100%. But the majority of the large structural improvements can be dropped from a 27.5-year depreciation lifespan to 15 years. Now, what does this mean for the newbie real estate investor? This means that depreciation, the deduction that you're taking on improvements to your property, big improvements to your property, instead of waiting 27.5 years to fully deduct that expense, you can now accelerate the deduction over 15 years. It almost doubles your write-off. Now, this isn't only for 2020. You can go back and do this for 2019 and 2018. Here's why you don't want to jump through that hoop just yet, though. You definitely want to analyze and see if it makes any financial sense for you to do this. But going back and amending a tax return opens up a can of worms with the IRS. One, yes, this is a benefit for you. But at the end of the day, going back and correcting an already filed return, it does raise some questions with the IRS. It gives them the ability to take a second look at your return. So if it makes financial sense, let's go ahead and do it. But if it doesn't save you anything significant, or let's say that you've been limited to the amount of loss deduction that you're able to take because of other individual or personal restrictions on rental property losses, you may not want to take advantage of this. It might not make financial sense. That's why you don't just want to do this on your own. You want to have a consultation with a tax advisor to make sure that, hey, if I go ahead and do this, does the benefit outweigh the risk, right? Because it's analyzing risk all the time. Is this risk going to put me at a higher potential for audit? And if it's only going to save me $300 or $400, why would I do that? I'm not saying $300 or $400 is not a lot of money. I mean, $300, $400, I'll take it any day of the week. But I think that what people are really looking for are the thousands and thousands of dollars in tax savings if they're going to reopen that file in front of the Internal Revenue Service. And remember that when you amend a tax return, you have to paper file the return. So no longer are you sending in a digital file, you got to mail in a tax return. So, and sign it and attach forms and all, it's a whole mess. So it's got to make sense financially for you to jump through all the hoops to do this. Some of my clients have hundreds of thousands of dollars in delayed depreciation or suppressed depreciation. So some of them, without having to do a full-blown cost segregation analysis where they pay an analyst to come in and analyze remaining depreciation and make special elections, this is something that you could really do just with a tax advisor. And it accelerates that write-off, almost doubling your depreciation deduction. So just understand that this is for qualified improvement property. It is not for building. The building that I'm sitting in, for instance, has a 39-year lifespan. I can't take the 39 years and depreciate it over a shorter period of time because it's the building. But if I blew out the side of the building and improved the property, that qualified improvement property can be accelerated over a shorter period of time. So once again, a million scenarios that we could go over. Any specific questions about this, we'll probably have to have a separate meeting about, because once again, I can't be general with this. Everybody's tax return is different. And some people might be limited on their rental property losses. Some people might already be fully depreciated. Some people might have made improvements in a year where they already made the accelerated election in past years. So there are a number of reasons why it might not make sense for everybody in today's webinar to do this. That's why everyone individually needs to analyze their tax return with a tax professional to make sure it works for them, okay? Stimulus checks, just wanna get this out of the way. They're still being cut. Some people have not received their stimulus check. Some people won't receive their stimulus check this year, and they'll have to apply for the $1,200 next year on their 2020 tax return. So just understand that it's not the fault of you, that it's not your fault, it's not the government's fault, it's not our fault, it's not tax preparers' fault. We have no idea how they're cutting these checks. I think that what they did was they sent the first round to lower income individuals. This is an assumption that I have, but the checks are still being cut. You can no longer have them directly deposited into your business or into your checking account, but they are still sending out paper checks, and those will be trickling out over the next couple months, if not through the end of the year. And then if you still didn't receive your $1,200 check, and you should have, you'll be able to apply for this $1,200 amount on your 2020 tax return in 2021. If you had income over $99,000 as a single individual, you did not qualify for it, AGI. If you are married filing joint and your AGI was over $198,000, you do not qualify for this benefit. So you phase in and phase out of this benefit. I believe for a single individual, your income could be as low as $75,000. If it was, then you qualified for it, but you phased out of that benefit at $99K. For married filing joint, it started at $150, fully phased out at about $198. So just understand that it all depended on your adjusted gross income in 2018 or in 2019, whichever you filed. So it's $1,200 per individual, so $2,400 for a married couple, and then per qualifying child, $500 per child. Will there be additional checks in the future? Like I said, you'll be able to apply for this benefit on your 2020 tax return in 2021. So just keep an eye open for that. Talk with your tax advisor. If you're a self-prepared taxpayer, just understand that if you don't make that election, you don't want to have to go back and correct it. So maybe because of everything that's happened this year with the PPP, the EIDL, with the changes to the stimulus check and the grant that you might have received, maybe if you are a self-prepared taxpayer, maybe it's time that you use a preparer, at least for maybe a couple of years until this dust all settles. Just a suggestion. Let's talk about identity theft really quick. This is a big thing that we're dealing with right now. It was a big thing back in 2015 and 2016. It has cycled back through again because people were at home working from their internet. People were getting hacked. Their bank account information was being stolen. They were being sold on fake ads and fake items online. Just understand that right now, identity theft is, once again, the #1 crime in America. It's the #1 crime globally. You need to look out for fake websites, phishing and vishing, spoofed government and health organization communications, miracle cures. I can't tell you enough. Do not buy into these miracle cures, okay? People will ask you for hundreds of thousands of dollars because they have the next cure for COVID-19. It's not true, okay? You need to, I don't care who you are in the webinar, you just avoid that like the plague, okay? Let the professionals do what they do, okay? Fake job postings, be aware of that. You know, I know that a lot of people, when they went into unemployment, they were applying for jobs, giving people their social security numbers, their bank information, because they were desperate. They needed to get back to employment. So just be aware that there are a lot of these things going on. How to recognize a scam. They insist that you act now and quickly. They need your information like yesterday. Includes your request for personal, financial, or medical information. Directs you to open attachments. Don't click links from untrusted sources online. And starts up with a generic greeting and has spelling or grammatical errors. You need to just make sure that you're dealing with a legitimate business. I have a lot of clients, even some personal family members have bought things online on Facebook with the Facebook ads or Instagram ads, and it's fake. It's fake because there's a lot of people out there really trying to scam people, taking advantage of people when they're down and out of luck. So just be aware of that. It's a crazy world we live in. Just try to steer clear of the crazy. All right. Before I go on, I just wanted to mention, I know that all of you who have seen me before, we offer free consultations. Because we're not in person, I can't have you fill this out. But I have a couple more slides after this. We're going to touch on things in more detail. I did want to show you that if you have to go early at the tail end of the seminar, you text RHA to 38470. That automatically submits you for a free 30-minute consultation. We do it by FaceTime, Skype, over the phone, however you want to deal with our firm. Text RHA to 38470. I will throw this back up. So I'm going to move on and I'll throw it back up towards the end. Just remember, and I'm sure that once again, if you heard me speak last time I was in person, I talked about qualified business income, QBI. QBI is still around, and this is actually, aside from the benefit of the CARES Act and the stimulus checks and the unemployment for contractors, the major benefit for a self-employed business owner is the tax-free benefit that the federal government put into the 2018 tax reform bill. This essentially makes the first 20% of your self-employed income or rental income tax-free. So we have to define QBI, right? Qualified business income essentially is self-employed income, either just regular self-employed income, self-employed real estate income, or rental income. Because a lot of people say, well, is rental income included in QBI? And that's why I put the question mark. This is a big question that we get. Well, QBI, qualified business income, can relate to either self-employed income or cash flow from rental properties. And if you meet the income requirements, and once again, this is a flow chart, and I'm sure that you've seen it before if you've heard me speak before, but this is essentially how you qualify for the QBI deduction that was passed in 2018 and is available for 19 and 20 and 21. Essentially, if you're married filing joint, you're going to go to the left. If you're single, head of household, and married filing separate, you're going to go to the right. If your taxable income married filing joint is under 321, single, if you're under the individual threshold of 160,700, you qualify for QBI, which could potentially make the first 20% of your business income tax-free. Let me give you an example. Let's say I'm married filing joint, both me and my spouse are self-employed. And let's say that after all expenses, our businesses total, when you add them together, let's say our profit was $300,000. We had a good year. We didn't really write off that much. We're showing $300K in self-employed income. Because we're under $321,400, that the QBI deduction, the QBI benefit made $60,000, 60000, $60,000 of our income tax-free. On the federal return, California has not conformed to this benefit, so just be aware of that. The federal government makes 20% of your QBI tax-free. On $60,000, shoot, let's say $60,000 at, let's say, a 24% tax rate, that's $14,400 in tax that you just saved. If you're in the 24% bracket and you saved tax on $60,000, that is a massive tax savings. That's way more than unemployment. Shoot, divided by 12 months, that's an extra $1,200. That supplements for the unemployment benefit of $600 or whatever, and you're only going to get that for a certain portion of time throughout the year. So just understand that qualifying for the benefits that are already built into the Internal Revenue Code, this is where the major benefit is. You got to do some planning ahead of time, right? You got to plan ahead to make sure that you're under these thresholds, because as soon as you're above one of these two thresholds, you start to phase out from this benefit. If you're married filing joint and you're above $421,400, and if you're single and you're above $210,700, you do not qualify for the QBI benefit. So you phase out from that benefit. So why not sit down before the end of the calendar year, before December 31st, figure out specific deductions you can take to reduce your taxable income, and that way you qualify for this benefit. And remember, this is not based on AGI. This is based on your taxable income, not your gross income. So this is after all of your deductions are taken into account. $321,000 is after you've written off everything. So you could be pumping $500,000, $600,000 of income gross, minus all of your business expenses, minus your deferred comp plans, your 401ks, IRAs, minus the car purchase that you made, equipment deductions, travel. And if you can get yourself below $321,400 for married filing joint and below $160,700 if you're single, 20% of your income doesn't pay any tax. I think I've hit that in the head enough. Just understand that this is a major, major benefit that's built in for business owners and for rental property investors. You got to make sure that you qualify for this benefit. Otherwise, you're leaving a lot of money on the table. Once again, we offer free consultation. So if you want a review of last year's tax return, we can take a look at it, see if you qualified for the QBI deduction. But that's how you're going to get the free consultation, texting RHA to 38470. I'll throw this back up at the end again. I do have a couple more slides to go through. Mortgage interest deduction. A lot of people, once again, they thought mortgage interest no longer a great tax write-off. I just had a client, a new client in my, not in my office, but on FaceTime yesterday, who was saying that her financial advisor was telling her to pay off her debt because she wasn't being allowed a benefit for it. And I said, well, that's very narrow-minded opinion, I think, or not narrow-minded, but that's not all of the information. You can't just say that, hey, you should pay off your mortgage because it gives you no benefit. There are a number of factors you need to take into account here. One, a primary residence mortgage tends to have a lower interest rate. It also is more secure. The bank is not going to kick you out of your home. Sure, they'll go into formal foreclosure, but they would much rather modify your loan or adjust your loan to keep you in that house. The bank does not want to own property. So for you to go and take all of your money and pay off your mortgage, right? A secured mortgage that has a very competitive interest rate, just because you're not getting a tax benefit on the individual side, that might not be the best option. I would actually much rather somebody pay off their rental property mortgage so that they cash flow more. So when they go to apply for another home loan to buy more rental property, they're a more competitive buyer. They're a more qualified borrower, so to speak. So it's a chess game with the banks. It's a chess game with lenders. It's making sure that your tax return looks good enough for the lender to say, okay, you're a qualified borrower. Here's some money to go buy another property. Mortgage interest, make no mistake, is still a great tax write-off. For the most part, it is a dollar for dollar deduction on the business side of things. But on your primary residence, remember that mortgage interest has always been limited on your primary residence. Under the old tax bill, for instance, you were only allowed the interest on up to the first $1 million of debt on your primary. And if you owned a second home, not a rental property, but a second residence, vacation home, a Big Bear property, or what, a second home, you're only allowed the interest on the up to $1 million of debt there as well. So $1 million here, $1 million there, first and second home. On a rental property, there was no limit. There is no limit because it's a business. So the interest deduction, the interest expense might be a little bit, or interest rate might be a little bit higher, but the deduction is absolutely great. But when you have that kind of debt on a rental property, when you go to apply for a loan, the lender's going to use that against you, and the debt to income ratio, it has to be competitive, so on and so forth. So once again, there's a chess game that you have to play with the lender and the banks. Mortgage interest is still a great tax write-off. It is still a tax deduction for you. Remember that under the new tax bill, the reason why this financial planner was advising this client to pay off their mortgage is because he took a look at her standard deduction, which for a single individual is at about $12,500, about $13,000. And he said, well, your mortgage interest is only $15,000. So why don't you pay it off? Because the first $13,000 wasn't even a write-off for you. Well, the financial planner is not a tax professional. So he's looking at just the mortgage interest. I said, well, no, technically it's not just $2,000 of your mortgage interest that you're writing off. Sure, your mortgage interest is $15,000, but what about your property taxes? What about your charitable contributions? See, when we added up all three of those, even though her property taxes were limited, we'll get to that next, even though her property taxes were limited, that plus her mortgage interest plus charity gave her an itemized write-off of about $27,000, which is well above the standard deduction. So it still was a major benefit for her as a W-2 wage earner to take that as a tax write-off, especially because she had a 3.275% interest rate or whatever it was, a very, very low, very competitive. She couldn't even qualify for a refi because her interest rate couldn't be any lower than where it is now. So just understand that every situation is unique. Every situation is different. You can't compare your tax returns to your neighbors or to your coworkers, to your friend, your family members. You got to make sure that you look at your scenario and figure out the best options and benefits for you individually, personally, not what benefits other people. That's why when I talk about tax code, a lot of clients will like to ask questions. Their questions sometimes tend to be very specific to their scenario. Every situation is different. So mortgage interest might be a benefit for this client that I talked to yesterday, but you might be in a different scenario, right? You might actually have very low interest deduction and only property taxes. And at that point, if your property taxes are low, let's call it $6,000, and your interest is $2,000 and your charity is $5,000, but let's say you're married, right? So you add up all those deductions. Let's say you have $13,000, $14,000 in itemized deductions, but your standard deduction as a married couple is $24,000. Well, none of your property is a tax write-off at that point on the federal side. California still allows it, but the federal government, because their standard deduction is $24,000, that gives you a much greater deduction than itemizing your mortgage and your property taxes and charity. Once again, every situation is unique. On the primary and the second homes, mortgage interest is limited. Under the new tax bill, the $1 million exclusion dropped to $750,000. But if you already had a $1 million loan in place before December 15th of 2017, you are grandfathered in to the old tax bill. So just understand, have this conversation with your tax advisor, figure out how this particular change impacted you. For the SALT deduction, state and local tax, remember that as of 2018, the max state and local tax deduction you are allowed is $10,000, meaning that out of the income tax you pay to California, out of your property taxes, out of your DMV fees, your sales tax deduction, max write-off is $10,000. Well, understand that under the old tax bill, there was already a limit in place. It was called alternative minimum tax, AMT. And so if you were limited under the old tax bill, this particular limit shouldn't have impacted you very much at all because you were already limited to the amount of state and local tax that you could write off. This is a very unique part of the new tax bill. If you don't understand how AMT works, if you know that you were subject to AMT, but you don't really understand how this is any different than from AMT, these are good conversations to have with a tax professional. And that's why we tell clients, hey, listen, after you've done all the planning, after you've structured your return and your businesses and entities and everything, what else should you do? You need to have advisors on your side, just like you surround yourself with like-minded individuals, business individuals, professionals. That's why Robert Hull & Associates offers the free 30-minute consultation. You'd be surprised at what we can cover in 30 minutes. A lot of individuals use this consultation to review previous year's tax returns that have been filed. A lot of clients utilize this to run scenarios by us, talk about the PPP, the EIDL, individual scenario situations. Sometimes it can't be answered in a forum like this with 94 people attending today. We're not going to be able to go into specifics because your situation is unique. It's different. It's special. And so this is just a huge tool for a lot of individuals who we've been able to help over the past, since 1971 of being in business, but more importantly, the amount of individuals we've been able to help over the past 3.5 to 4 months. We haven't even seen, I don't want to be negative here, but we've only seen kind of the tip of this. Once the economy opens back up, there will still be other things that we have to deal with. You might be back to business, but the economy as a whole, they've been injured. We've been injured, and we need to take the time. We need to take it slowly. We need to learn from some of the mistakes that we've made. We need to make sure that we're healthy and that we're safe and that we're keeping others healthy and safe. So just understand that for now, this is going to be by phone, FaceTime, Skype. But when we open back up, meet us in person. But this is really to get the information to you, the taxpayer, to make sure that you're not missing out on a lot of the benefits that are built into the current tax bill, as well as taking advantage of some of the support and relief programs that were released under the CARES Act. Once the HEROES Act fully passes and we know once the dust settles on that and what the final legislation is, we'll come back to you with a whole new PowerPoint pertaining to the HEROES Act. But until then, this is the information that we have, and it is all subject to change. Utilize this consultation for you, for your neighbors, your coworkers, your friends, whoever you think might need free consulting for 30 minutes to review taxes, to talk about PPP, EIDL. Give this to them. Take a picture of the screen if you'd like. I'm going to leave this up, but I believe that we're going to wrap up. That's the end of my presentation today. Thank you so much for having me. And if we have a couple questions, I think we can go over some if we have time. But once again, utilize this. Utilize the free consultation for all of those questions. And that way we can dive into more detail and get you the answers that you need. Okay. Let's see. I guess, I'll go back to the chat box. Welcome on, attending, educate. Okay. Was the $1,000 grant taxable? No. So I mentioned this earlier when we were talking about the EIDL. The $1,000 grant is not taxable at the moment. Once again, the IRS has not created any legislation around whether or not the $1,000 can be taxable. It does not have to be paid back. And at the moment, it is not going to be taxable income. I do not think that it will be, especially because of the whole purpose of this was meant to relieve people of additional liabilities, right? It was meant to support them and not put them out on the street. So the $1,000 grant, I know Gary answered that, but I just want to mention it's not taxable. I have W-2 employees. Can PPP pay for payroll tax and workers' comp premium? So the payroll protection, if your workers' comp premium was a consistent benefit, a fringe benefit, or an employee benefit package that you were offering to your employees, then yes, it can be. But if this is something that you just recently started because of the pandemic, no. And remember, workers' comp for contractors would not be. So if you're paying workers' comp for contractors, no, because contractors are not employees. But if you have a workers' compensation plan to protect your employees or some type of insurance policy for your employees, then yes, technically you could, as long as it's been consistent with your business. And remember that is kind of like health insurance, right? It's to protect your employees. If it was only for you, that may be limited because technically you could have other types of insurance liability protection plans that might not be the same type of benefit. So just be aware that it really all depends. For payroll employees, if it's been consistent, yes, you can utilize that for that. How does PPP calculate real estate agents' compensation in the forgiveness application form? SBA uses payroll to calculate, but real estate agent only receive commission. So how do we calculate the allowable 70? So remember that you have to look at the past 12 months of revenue, profit, and that is your monthly compensation. So technically, if you were making that $120,000 over a 12-month period, that's $10,000 a month. So over the next 8 weeks, $10,000 divided by 4 weeks in a month is what? $2,500. So technically, you would have to pay yourself $2,500 a month, or up to a minimum $2,500 a month with the PPP. And that should cover, I mean, shoot, $25,000 in this particular example. 25,000 divided by 2,500, you're looking at 10 months. So you might actually have to pay yourself a little bit more if you're utilizing 100% of the PPP loan to cover the payroll costs for you. So remember, as a contractor, it has to be per month, and it goes off net revenue, not payroll, because you're not a payrolled employee. So hopefully that makes sense. If your last payroll includes workers, obvious payroll, I think that was kind of answering that question. Do you know when EIDL? I do not, unfortunately, know when EIDL will open back up. It's something that probably pertains to the passing of the HEROES Act. They're looking for more funds. And this new package, I believe, is another multi-billion-dollar package. So we'll see. We'll see. We don't have any final legislation on that, though. I have confirmation number on EIDL, $1,000, but not yet received this amount. Is there a number for me to call? Check the status. You probably would call SBA directly if they're answering their phones right now. If you have a confirmation number, technically you should have already received it. If it's been like a couple weeks, 3 or 4 weeks since you got that confirmation number, you absolutely want to reach out and make sure that money didn't get wired to somebody else. Like I said, there's a lot of fraud, a lot of identity theft going on right now, so just be aware of that. Can I still apply for the 10K? No. So EIDL, the grant, and the loan applications are closed. So the only loan applications that are being accepted are the PPP loans at the moment. PPP is for bona fide employers. If you are employed and receive a salary from a company, then you will qualify. Real estate agents or independent contractors. And real estate agents are applicable for PPP, though. That's the thing. It's not for bona fide, but you are an employee. So technically, when you apply for PPP as a contractor, it's based on your annual net revenue. So please don't tell contractors that they're not eligible for the PPP, because they are. I have hundreds and hundreds of contractors who have already applied for PPP and who have qualified for the payroll protection program. So just be aware of that. So can a real estate agent use commission? Yeah, so remember that commission, your 1099 commission is not your payroll. It's your monthly profit. So if I bring in $120,000 of commission and I subtract all of my expenses, right? And let's say I write off $70,000 in expenses and I have $50,000 of profit. I have to take that $50,000 divided over 12 months, and that gives me my monthly net revenue. That would be my payroll figure, and that's what the banks are using for the PPP application. So in that situation, 50,000 divided by 12, that gives me $4,100 of monthly net profit. The lender will take that times 2.5, and in this particular situation, if $50,000 was your profit, your PPP loan amount would be about $10,500. Because that's the calculated amount that essentially covers you for 2.5 months. So just be aware that contractors still qualify for this, but the application is different because you don't have payroll. You actually just have profit through your business, but that is technically in replacement of your payroll, of your potential payroll. So just be aware of that. One more question here from Bill. For husband and wife, both licensed, work as a team with a broker under LLC and get a 1099 for broker. Can you write, can the wife file unemployment from EDD for herself? The wife only filed tax return, son married, husband already got UI weekly paid. So once again, if you are paid, the only way that you get unemployment insurance, the regular unemployment, is if you have received W-2 compensation. That's regular unemployment. So if you worked for a business that you own and you paid yourself W-2 last year, yeah, you paid into unemployment. You could technically file for unemployment, but regular unemployment. If you got paid into a business and then you paid yourself 1099, one, that's the incorrect way of paying yourself because you cannot be a contractor of your own business. Two, yes, could you technically apply for unemployment? You could, but once again, if unemployment or if EDD ever audited you and they found that you 1099'd yourself from your own business, they would ask for that money back and probably penalize you because you're not a contractor. You cannot contract with your own company. You have to pay yourself W-2 if you have a corporation. If you're a sole proprietor, different story. A sole proprietor can apply for the PUA benefit, which is the contract unemployment, okay? So I know that somebody's got to hop on at 11, so I'm done. Sorry for going over there. I just want to make sure I got all the questions answered. And if for those of you who have other questions, text RHA to 38470. Thank you so much for including me today.
Thank you, Tony. Do we still have other questions?
Oh.
No. And everyone knows Tony is the best speaker and the best text preparer for us, right? And Tony, on behalf of Western Gable Valley Realtors, Education Committee, we really want to appreciate you and thank you very much for your wonderful and informative presentation today. We all know all the tax rule is changing, so you might need to coming back very soon in a couple months later. And we thank you so much for we have a very high registration numbers, and we have wonderful coming in attendance record. You're so wonderful. We want to say thank you again. And today we want to say thank you again for all your attendance. On behalf of West and Gateville Valley Realtors Education Committee, we welcome you for the continuous tomorrow's Emirates Breakfast meeting at 9 and the coming Global Real Estate Market Trend Series webinar. And we welcome you attend our every meeting to update us, to prepare when the market open, we are ready to go. Thank you, Tony. Thank you very much. Have a great day. Have a
You as
safe
well.
day.
Take care.
Thank you. Take care.